Welcome to the deep dive. Today we're cutting through the noise, really focusing our attention on the entertainment sector. We're pulling apart the three highest volume stocks trading above $10 that you flagged in your latest screener.
Yeah, that's quite a list. It gives a fascinating snapshot, really, of where the risk and maybe the opportunity is sitting right now. So what we're doing is a comprehensive journalistic review. We've got Leifras Co Ltd ADR, ticker LFS,
Right.
Warner Bros., Discovery Inc., that's WBD, and the newly merged Paramount Skydance Corp, PSKY.
Okay, and our mission here is to really analyze the core data for each one. You know, the fundamentals, technicals, the news flow, valuation, and then we'll run a sort of fun, hypothetical $5,000 paper trade scenario for each stock.
Yeah, just to illustrate the sheer scale, the volatility we're actually seeing in this space.
Exactly.
But before we jump in, we have to state this clearly. This analysis is purely for informational, educational purposes. It's all based on public financial data. It is absolutely not investment advice.
Okay. Absolutely critical point. And what strikes me immediately, even before we look at the numbers, is just how different the strategies and the risks are here. You've got this Japanese microcap, LFS, sitting right next to two massive U.S. media giants, WBD and PSKY. But across all three, there's this pattern emerging, isn't there? The sector seems to be valuing explosive potential, M&A,
Right.
event risk.
Way more than just stable current earnings. And that difference, I think, is going to be really crucial as we look at these numbers.
Okay, so let's unpack the real outlier first.
Yeah.
LFS, Leifras Co Ltd ADR. It's, like you said, a relatively tiny Japanese microcap. They do sports training, event management, market cap just shy of $300 million. And they're really new, right? IPO was just October 2025.
Yeah, very recent. And LFS immediately shows you the high wire act of microcap trading. Just look at the price action on November 11th. The stock closed at $11.37. That's a single day change of 576.79%.
Wow, 576% in one day. That's not a market finding a stable price. That feels like a pure event, like you said, almost a frenzy.
Exactly.
And looking at their basics, the profit margin is pretty thin, only about 3.89%. So are we looking at a solid business here, or is this just, a mechanical reaction to some kind of flash pump?
Well, that's the million-dollar question, isn't it? And it goes right back to the main theme here. The valuation is aggressive, very aggressive. Trailing PE is over 103. Price to book nearly 40. Now, they do have some impressive internal metrics like return on equity around 49%, which is good. But that valuation, it's clearly built on hope, on massive future optimism, not current profit stability. It's pricing in, let's call it, a ghost of future growth.
So what actually drove that massive spike? We know there was some recent news, a contract in Nagoya City Q2 financials.
Yeah.
But that doesn't explain 576%, surely.
No, not even close. It was entirely volume-driven speculation, pure and simple. We saw over 34 million shares trade hands that day. The relative volume was over 49.
49. So it traded nearly 50 times its average volume.
50 times, yeah. When that happens, forget fundamentals for a second. The technical indicators just scream danger.
Okay, let's talk triggers then. Buy-sell triggers. When the price blasts off that far above its moving averages, where's the momentum indicator sitting?
Well, the 14-day RSI, the relative strength index, came in at a blistering 82.50.
82.50.
Yeah. Anything over 70 is usually considered severely overbought. So 82.50, that's extreme, unsustainable buying pressure. It signals a very, very high risk of a sharp correction, maybe even a reversal. This move is speculative, short-term, and frankly, extremely high risk.
Okay, let's try and illustrate the lure of this kind of volatility with our hypothetical $5,000 paper money math. Let's use the price from the day before that spike, right? The previous close was $1.68.
Okay, so if you had hypothetically put $5,000 into LFS shares at $1.68, let's see, that would get you roughly 2,976 shares.
Right, 2,976 shares. Then selling those shares at the closing price of $11.37 on November 11th, you'd be looking at a total value of $33,837.12.
Which translates to an estimated paper profit of $20,837.12.
Wow.
A 576.74% return. Hypothetically, of course, in just a matter of days.
That's incredible. It shows you why people chase these things, doesn't it? But it also shows why getting in at $1.68 requires, nerves of steel to take on that kind of microcap risk.
Absolutely. High risk, potentially high reward, but extremely volatile.
Okay, let's shift gears. Moving from that chaotic microcap world of LFS, we turn to WBD, Warner Bros. Discovery, a $57 billion U.S. giant, part of the S&P 500. Totally different beast.
Completely different. And here, the volatility isn't driven by a single contract. It's driven by this huge game of M&A chess being played out in the open.
Right. The whole story seems to be M&A speculation, isn't it? Potential sale, maybe a split up, talk of bids for Netflix or Comcast. I even saw an analyst mentioning a $30 per share target if a deal happens.
Yeah, that number's been kicked around. It's classic M&A arbitrage fueling the price right now. The news flow is the main technical indicator, in a way.
And the recent Q3 earnings wasn't that interesting. They missed on revenue, but the CEO was very public about evaluating options for a sale or split and doing it quickly. That just kept the M&A talk going.
Absolutely. Kept the engine running. And the technical picture really reflects all that hype. The stock's been flying. Closed recently at $23.05, just what, 4 cents off its 52-week high?
Incredible. $23.06 is the high. And the performance has been huge, up over 91% last quarter, 146% over the year. It's recovered massively from that 52-week low of $7.52.
Huge recovery.
So given that massive run-up, what's our buy-sell indicator, the RSI, showing for WBD's momentum now?
Still hot.
Still very hot. It's also technically overbought. The RSI is at 75.33.
Okay, so over 70 again.
Yeah. It basically means if you're buying today, you're betting almost entirely on that external M&A action, pushing it even higher, past the current resistance. You're betting on the deal happening, not just the company's organic growth. Which kind of brings us to the analyst, doesn't it? Because WBD is trading near $23. The overall analyst recommendation leans towards buy. It's at 2.03.
Yeah.
But their average target price is $22.56.
Right.
Which is already slightly below where it's trading now. So why is the market ignoring the professionals or being so much more aggressive?
Because, well, in this kind of event-driven situation, the market often thinks it knows better, especially about the timing and odds of a big merger. Fundamentally, the valuation is high. That PE ratio is way up there at 122.87.
Yeah.
And you see this weird divergence in future expectations, too. EPS this year, positive 108%, but next year, projected sharply negative, minus 140%.
Whoa.
The PEG ratio, 1.69, confirms investors are paying a premium for growth that's really erratic and depends heavily on these potential events.
Okay, let's get to our WBD paper money soon. Given that huge recovery, let's imagine you, the listener, had the foresight, or maybe just the luck, to buy at that 52-week low, $7.52, when things looked pretty bleak.
Okay, $7.52. A hypothetical $5,000 purchase back then would get you about 665 shares.
Right. Selling those 665 shares at the recent close of $23.25, that works out to a total value of $15,338.25.
So your estimated paper profit in that scenario, $10,338.25, a 206.77% return.
Pretty good. It shows the kind of reward possible when a major company turns things around and gets caught up in that heavy M&A speculation. From the abyss to potential buyout target.
Exactly. A very different story than LFS.
All right, finally, let's look at PSKY, Paramount Skydance Corp, about an $18 billion market cap. And here, the volatility seems driven less by external bids like WBD or microcap speculation like LFS, and more by, well, the pain and the promise of a massive internal restructuring. This stock's really defined by being the new kid on the block, right? Combining Paramount, Skydance, brands like CBS, MTV, Paramount Plus. That merger only happened back in June 2024.
Yeah, still pretty fresh. And PSKY's recent movement is definitely tied to how well they execute this turnaround. The share price jumped, what, nearly 10% after Q3 earnings?
9.77%, yeah.
And that seemed driven by reported streaming growth, but also news of really aggressive cost-cutting, slashing about 2,000 jobs.
Right.
Alongside a big $1.5 billion programming commitment. It's a very aggressive pivot, trying to get to profitability fast.
Okay, so looking at the technicals here, the momentum seems a bit mixed. It had a strong week, up almost 13%, but the month is actually slightly negative. The price is above its 20-day average, but a bit below the 50-day.
Exactly. The signals are kind of neutral right now. The RSI is 55.08, right smack in the middle.
Okay.
Relative volume at 1.23 is a bit elevated, suggesting more activity than usual, but it feels like the market is sort of waiting and seeing if these big restructuring plans actually deliver stable profit down the line.
Fundamentally, PSKY looks like the trickiest one, maybe. The trailing PE is NA because earnings have been negative. They lost, what, $272 million net income? The company's actually losing money right now. That's the upfront cost of a big restructuring, isn't it? But the forward-looking numbers, that's the story the market seems to be latching onto. Yeah. Forward PE is around 16.
Which reflects expectations that EPS next year will grow by almost 17%. So the market is essentially pricing in the success of those job cuts and that big content investment paying off.
But the analysts, They seem pretty skeptical. The recommendation is 3.42, which leans towards sell or underperform, right?
That's a cautious stance,
Yeah. And maybe more telling, their average target price is $13.81. That's way below the current $16.74 trading price. So is the market just too optimistic about the cuts? Or maybe the market sees the long-term value of that content spend better than the analysts currently do?
It's a classic split decision. You've got high institutional ownership, over 80%, suggesting the big long-term players are buying into that future growth story, despite the current losses and the analysts' warnings. It seems the market's valuing the CEO's commitment to making aggressive changes.
Interesting dynamic.
Yeah.
Okay, final paper money scenario. Given that analyst target of $13.81 represents Wall Street's current, let's say, pessimistic view. Let's imagine a listener bought $5,000 worth right at that target price, betting the analysts were actually being too cautious.
All right, buying $5,000 at $13.81 would net you approximately 362 shares. Selling those at the current close of $16.74 gives you a total value of $6,059.88.
Okay, so the estimated paper profit there is $1,059.88. That's a 21.20% return.
Decent return.
Yeah, solid, but it definitely demonstrates a lower stakes kind of volatility compared to the others, driven more by internal stuff, operational changes, rather than that extreme event risk we saw with LFS or the big M&A gamble with WBD, #outro. So we've looked at 3 stocks, each with a really distinct financial story playing out. LFS, the microcap, all about explosive speculation and volume. WBD, the giant, completely dominated by M&A talk and split potential. And PSKY, managing that critical post-merger restructuring.
Yeah, and the overarching insight, I think, is pretty clear. Right now, in this entertainment sector, narrative seems to be trumping net income.
Good way to put it.
The extreme valuation differences, LFS at 103 PE, WBD at 122 PE, PSKY with negative current PE. But those aggressive forward projections, it just shows that the market participants are valuing growth stories, M&A potential, aggressive turnarounds, much more than just current stable earnings.
Right.
And that's why the news flow and the technical indicators often feel like they take precedence over the traditional fundamentals in this space right now.
It makes tracking these stocks almost like being a journalist as much as a financial analyst. You have to follow the story.
Absolutely. And our analysis showed that for all 3 of these stocks, which are volatile and event-driven, the gap between the 52-week low and the 52-week high is just enormous. We're talking hundreds of percentage points.
It's huge swings.
Which really leaves us with a central challenge for anyone looking at this space, doesn't it? When news events, not slow, steady business growth, can drive swings of 200%, 500% in a year, how do you define your buy or sell trigger? That's the tough question you really have to answer for yourself when you're navigating the high-stakes, fast-moving entertainment sector.